Welcome to Stony Finance Lab channel.
Once you start investing, it is easy to get overwhelmed with the possibilities of what to do with your investments. So, let's go over some helpful tips on what you should be investing on and strategies to help you grow your investments. Today, we will be talking about what you should do before investing, ideal types of investments, and the best strategies to commit to. Before you even start investing, it is important to make sure of a few things. First, it is important to have a rainy day fund or an emergency fund in case of accidents, emergencies, or unexpected bills. Next, you should also make sure you pay off any high cost debt, which includes credit card debt and loans. According to the New York Times article, The Young Person's Guide to Investing, you should be saving anywhere from 3 to 6 months worth of living expenses in the bank. You should not be using money that is needed to pay for your living expenses or bills. This includes groceries, gas, or transportation bills, and rent. The number one advantage investors have over other investors is time. Time is something that is not compensatable. Starting early always gives you the most time to let your investments grow. ETFs, or exchange traded funds, and mutual funds are easy and safe choices for beginners. Researchers have already done the work of researching and picking the best stocks, and you do not need to go through the trouble of picking your own stocks. 401k and Roth IRAs are both options to let you get closer to your retirement. 401k allows for matching from your employers, and this allows you to maximize your contributions as much as possible. While Roth IRAs are more profitable because the money going in is already being taxed, so it won't be taxed at the end when the sum is large. Compound investing is used for long-term growth. Dividend investment is when a company offers earnings to investors regularly, either monthly, quarterly, or annually. Investors are able to build a consistent stream of passive income through this. And if you start in your early 20s, you have over 40 years to grow your investments. According to the same New York Times article titled The Young Person's Guide to Investing, the payoff for investing earlier is exponentially higher than starting later. Assuming that one invests $5,000 annually at age 22, which is the graph that is green, and assuming another person invests $5,000 at age 32, the line in purple, both with a 7% return and will retire at age 67. You can see that investing early gives you $1.5 million at the age of 67, while you only get $750,000 if you invest starting at age 32. A difference of just 10 years makes a huge difference money-wise. However, if you're investing for a short-term goal, like a vacation or a new car, it is better to put your money in a high yield savings account with a high interest rate. You would ideally put in money monthly until your short term goal is reached. Now, you know why it is important to start investing early. Let's talk about the kind of investments that are ideal. First are mutual funds. A example of this is S&P 500, which is a basket of the best 500 stocks. This is a good representation of the stock market, and it is a cheaper option. This is considered to be a low expense ratio, which is the average cost investors pay. Next are exchange traded funds, or ETFs, which are cheaper options with a lower expense ratio as well. This automatically diversifies your portfolio. Examples of ETFs are ticker symbols SPY, VTI, SCHB, and QQQ. Lastly, real estate is a great tangible option that is able to help generate income and is a great inflation hedge. This means that its worth will either continue to be maintained or increase over time. REITs, or real estate investment trusts, are mutual funds that invest in real estate. One strategy is called averaging down. Averaging down ensures that you buy an investment when the price drops significantly after your first initial investment in order to decrease your average. If the stock goes back up, you will earn more, but if the stock continues to drop, your losses are also a lot more. So it is important to do your research on what you should be averaging down on. Blue chip companies like FANG are always ideal to average down on. Another strategy we will talk about is dollar cost average. This means investing a set amount of money into an asset regardless of the asset's price regularly. This reduces volatility of markets, and investing in smaller quantities over time allows you to maximize paying lower prices. It also helps you from wanting to time the market, which produces less gains anyways. So, a recap of what we talked about. It is always best to start investing early, like in your early 20s, so you have many years ahead of you to let your investments grow. But before you invest, always make sure you have money saved for emergencies and for your living expenses. From there, when you are ready, There are many ways you can invest, like through mutual funds, real estate, Roth IRA, or 401ks, and strategies like averaging down and dollar cost averaging will definitely help.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.